Everyone thinks it was just about interest rates, that in 1994 the US Federal Reserve raised them a bit too fast and bondholders got nervous. That's what the textbooks say. But it's not true. The 1994 bond shock was not about a single policy mistake. It was the result of a system quietly being pushed past its limit, a global game of promises backed by debt, not gold, and certainly not productivity. In just a few months, the bond market, the hidden bloodstream of the world economy, was nearly paralyzed. Markets lost over $1.5 trillion in value. Orange County, California, one of the richest counties in the U.S., declared bankruptcy. Hundreds of billions evaporated in pensions, savings, and credit markets from Tokyo to Toronto. But here's the twist no one talks about. The real cause wasn't the rate hike. It was leverage, invisible leverage, built on years of artificial calm. Funds, institutions, even local governments were sitting on piles of borrowed money, all based on one assumption: that bonds don't move like stocks, that debt is safe. And then it moved. Government bonds, especially U.S. Treasuries, are supposed to be the anchor, the most stable, the most boring. But in 1994, they moved like tech stocks in a panic. And when they did, every portfolio, every risk model, every pension assumption collapsed with them. What's worse, the same dynamics are now 10 times larger, more leveraged, more complex. And this time, we're not starting from 6% interest rates, we're falling toward them. If you're watching this in 2025 or anywhere near it, understand this. What broke in 94 was never fixed. It was simply covered over with more promises, more derivatives, more central bank intervention. And the mechanism that failed back then is doing the same thing now, but with far more at stake. This isn't just about finance, it's about power. Because whoever controls the bond market controls the state. And when the bond market revolts, governments kneel. Stick with this, because the 1994 shock wasn't an anomaly, it was a warning. To understand what shook the world in 1994 and what's shaking again now, we have to go deeper than interest rates. We have to look at what the bond market actually is. Not just how it works, but why it exists. Because behind every financial crisis, there's always a design. The modern bond market didn't evolve naturally. It was built brick by brick after 1944 in Bretton Woods, and then rebuilt again in the 1970s after the dollar was uncoupled from gold. What replaced it wasn't just fiat money. It was sovereign debt, government promises, turned into a global asset class. Governments used to borrow from their own citizens, but now they borrow from the world. And the U.S. government, it became the center of that spider web. Its bonds, U.S. Treasuries, were chosen as the risk-free foundation of the global financial system, not because they were always safe, but because they were backed by empire. After Nixon closed the gold window in 1971, the world had a choice: chaos or a new anchor. So they picked U.S. debt. Not gold bars, not industrial output, but IOUs with military bases behind them. Foreign central banks, like Japan's, China's, Saudi Arabia's, began buying treasuries in bulk, not out of love for American paper, but because they had to. If you sell oil, semiconductors, or cars priced in dollars, you park your earnings in the dollar's safest form, U.S. bonds. And Wall Street? It saw a feast. By the 1980s, investment banks had built a whole industry around this structure. Borrow cheap, buy government debt, make a small spread, leverage it up. It was boring, predictable. But in finance, predictable means powerful. And then came the quants. Mathematicians turned traders. They built models, simulations, algorithms, all assuming that bonds had low volatility, that they don't jump, that they don't crash, that the spread was eternal. That illusion gave birth to a monster, the carry trade. You borrow in short-term markets at low interest and use the money to buy long-term bonds that pay a bit more. The gap is your profit. Tiny, but when you add leverage, massive. Pension funds, municipalities, hedge funds, even foreign treasuries began doing it. Billions turned to trillions. But here's the catch. This entire mechanism works only as long as interest rates don't rise fast. Because when they do, when long-term bonds suddenly lose value, The leverage unwinds like a snapped rubber band. That's exactly what happened in 1994, and what's building again now. Because systems don't collapse from ideology. They collapse when the math stops working. And in the early 90s, the math was already fraying. Japan had just crashed. Its bond buying spree was fading. Germany had just reunified, flooding Europe with new debt. And in the US, after years of post-Cold War calm, inflation started flickering back to life. So Alan Greenspan, then Fed chair, decided to get ahead of it. In February 1994, he raised interest rates. Not by a lot, just 0.25%. But that tiny move exposed the whole system. A bond market bloated with assumptions, derivatives, and carry trades had no margin of safety. It was never about rates. It was about structure. And that structure had been laid, piece by piece, since the fall of gold. Governments became addicted to bond markets, and bond markets became addicted to stability. The problem is, stability isn't real. It's manufactured. And when the illusion breaks, it doesn't matter what central bankers say. The unwind writes its own rules. For a while, it worked like magic. After 1994, central banks learned their lesson. Not about debt, but about optics. They realized it's not the size of the move, it's the element of surprise that kills. So they got smarter, more predictable, more reassuring. And with that, the bond market entered its golden age. A world of declining interest rates, stable inflation, and rising asset prices. From 1995 to 2007, you could throw a dart at almost any bond, corporate, municipal, sovereign, and make money. Why? Because the entire system was expanding, not in productivity, but in leverage. Governments borrowed more, corporations issued bonds to buy back their own stocks, pensions chased higher yields. And Wall Street built instruments so complex, even the people selling them didn't understand the risks. But it all rested on one fantasy, that interest rates would stay low forever, that central banks would always be there to save the market, that debt could rise faster than real income without consequences. It was the same illusion the French had in 1788 with their assignats, paper backed by land, inflated by hope. Or the British East India Company in the 1760s, selling bonds on future tea revenues, even as their trade routes collapsed. Back then, they called it confidence. Now we call it forward guidance. By the late 90s, the bond trade was so massive it became self-sustaining. Big investors didn't just buy bonds, they engineered them. They structured portfolios, insurance contracts, and interest rate swaps, all priced off the same assumption, that the U.S. Treasury would never default, and that central banks would never let bond markets fall too fast. Every pension fund, every mortgage lender, every sovereign wealth fund was plugged into the same matrix, a matrix where bonds don't crash, where inflation stays tame, where debt always finds a buyer. And for a while, the illusion created real effects. Low bond yields meant cheap mortgages. Cheap mortgages meant rising home prices. Rising home prices meant people felt richer, so they spent more. It was a bond-fueled wealth effect, a confidence bubble. But confidence is not capital, and feeling rich is not the same as being solvent. Still, no one wanted to leave the party. Not the governments rolling over their debt, not the banks raking in fees, not the consumers living on credit, and certainly not the investors making 30-to-1 leveraged bets on 10-year treasuries. The system kept growing because everyone needed it to. Even foreign central banks kept buying U.S. bonds, not just to earn interest, but to keep their currencies weak and exports strong. Debt became the currency of diplomacy, of politics, of illusion. And beneath it all, something even more dangerous was happening. Risk was being hidden, not eliminated, just pushed off the books, into hedge funds, into derivatives, into places regulators didn't understand or chose not to. The illusion of safety made people take greater and greater risks, like a dam with cracks beneath the surface, holding back an ocean of leverage. As long as the surface is calm, nobody moves, nobody questions, nobody prepares. But cracks don't fix themselves, they grow. And by the early 2000s, the same mechanism that nearly collapsed in 1994 was not only back, it was 3 times bigger. Every hedge fund was a bond fund in disguise. Every safe asset was built on borrowed money. Every government budget assumed rates would stay low forever. No one had a plan B. They didn't think they'd need one. It started quietly. February 1994. The Federal Reserve raised interest rates by just 25 basis points, 0.25%. No press conference, no forward guidance, no soothing words. Just a cold, unexpected announcement. Wall Street didn't panic, not at first, but the math started breaking immediately. Because this wasn't about rates, it was about duration. How long the bondholders had locked in low yields on massive portfolios. It was about leverage, how much they had borrowed, assuming nothing would change. And it was about assumption, the deadliest drug in finance. The rate hike was the match, but the room was already filled with gas. Bond prices fell, and not just by a little. Some U.S. Treasury bonds lost 15 to 20% of their value in a matter of weeks. For the so-called risk-free asset, that was seismic, because bonds weren't supposed to behave like that. Every model said they couldn't. Every stress test said they wouldn't. And yet, they did. Panic spread through the plumbing of the financial world. Orange County, California went bankrupt. Their treasurer had bet billions on interest rates staying low, borrowing short to buy long-dated bonds. A small move up in yields wiped them out. Gone. $1.6 billion in losses. In Mexico, the peso collapsed. Capital fled overnight. The U.S. had to step in with a $50 billion bailout just to stop the bleeding. Bond markets in Europe and Asia followed suit. Central banks were forced to intervene. Pension funds had to rebalance, triggering even more selling. It wasn't just a U.S. event, it was global, because by then, everything was tied to the U.S. bond market. Foreign reserves, corporate balance sheets, swap agreements, even currencies. And as bond yields shot up, the entire financial system repriced overnight. Risk became visible. Liquidity vanished. Leverage turned from an asset into a bomb. But here's the most dangerous part. There was no villain. No subprime mortgages. No Wall Street fraud. Not yet. Just the cold arithmetic of debt. If you bought a 30-year bond paying 6% and yields suddenly moved to 7%, your bond wasn't worth the same anymore. And if you had borrowed 10 times your capital to buy it, that loss became fatal. Arithmetic doesn't care about intentions. It doesn't care about prestige. It doesn't even care about the Fed. And that's what makes bond shocks so brutal. They expose everyone, from the world's largest hedge fund to the local fire department's pension plan. There's no place to hide, because bonds are the hiding place. Even Greenspan was caught off guard. He later admitted they didn't expect the reaction to be so violent. They believed markets would absorb it gradually. But markets don't absorb, they avalanche, especially when built on trust instead of collateral. The 1994 bond shock taught one lesson. Leverage turns small surprises into system-wide detonations. It's not the size of the fire, it's what you've stored in the walls. And here's the terrifying echo. 2025 isn't just repeating that story, it's amplifying it. Because since 1994, central banks didn't fix the structure. They just papered over it with more intervention, more QE, more debt. We went from being burned by leverage to building the entire global system on it. What collapsed in 1994 was a relatively simple system. What we're facing now is 10 times more complex and 100 times more sensitive. And still, the assumption remains that bonds are safe, that governments always pay, that risk can be modeled, priced, and insured. But assumptions don't stop gravity. They just delay the fall. If you're starting to see the cracks in today's safe system, share this with someone who still believes debt is neutral. After 1994, they said it was a fluke, a policy misstep, a communication error. But the truth is darker. It was a stress test. And every solution they applied after made the system more fragile. Instead of reducing leverage, they institutionalized it. Instead of taming the bond market, they financialized everything. Fast forward to today. We're in a world where every government budget, every corporate expansion, every pension promise depends on borrowing at low rates forever. Look around. Global debt has exploded from about $40 trillion in the early 90s to over $300 trillion today. Public, private, sovereign, shadow, it doesn't matter, because it's all priced off the same foundation: government bonds, the safe asset, the asset that can't fail until it does. And here's the trap we've built. Central banks can't allow bond yields to rise too quickly because the entire financial structure will snap. But they also can't keep yields artificially low forever because inflation eventually ignites. So they bounce between the two, pretending to fight inflation while quietly managing liquidity for the bond market, hiking rates publicly while buying debt privately, talking tough while backstopping everything with printed money. That's not capitalism. That's monetary theater. And it gets worse. After 2008, they added a new fuel to the fire: quantitative easing. Central banks printed trillions and used it to buy government bonds, forcing yields down even further. It was supposed to be temporary. It became permanent. And as rates stayed near zero, governments lost discipline. They didn't just borrow to survive, they borrowed to spend, to stimulate, to bribe voters, to delay hard choices. We now live in what economists call a fiscal dominance regime. That's a polite way of saying the bond market controls everything. Every interest rate decision, every central bank press release, every budget proposal. It all comes down to one question: can we keep borrowing? And yet, here we are in 2025 with yields rising again. Not because of policy errors, but because reality is catching up. The inflation triggered by the pandemic and war spending hasn't vanished. Geopolitical trust is eroding. The BRICS nations are de-dollarizing. Japan is starting to sell U.S. Treasuries to defend the yen. China is sitting on the sidelines. And the Fed? It's trapped between inflation and insolvency. Because this time, the math is worse. The U.S. government is running $2 trillion annual deficits at interest rates 5 times higher than in 2021. Debt servicing alone is now exceeding $1 trillion per year. It's 1994 all over again, but with dynamite under every floorboard. Pensions? Still betting on long-term bond returns. Banks? Still mismatched on duration, as we saw with the collapse of Silicon Valley Bank in 2023. Governments? Still issuing debt like inflation was a dream. And Wall Street? Still selling the same carry trades, the same derivatives, this time with AI-generated risk models. The ghost of 1994 isn't in the past. It's in every bond auction that almost fails. It's in every rate hike that spooks the repo market. It's in every central bank speech that carefully avoids saying what everyone knows. The system depends on cheap debt, and cheap debt is disappearing. We've built a global economy where the cost of money can never go up, even though it must. Where governments act like they can borrow infinitely as long as someone buys the bonds. But who buys when trust fades? That's why 2025 feels unstable. Not because something new is breaking, but because the old breaks were never fixed. The illusion of the safe bond is collapsing, and when that illusion dies, the system has to choose: default or debase. If you're watching this and wondering where it leads, say it out loud. It was never about rates. It was always about trust. Empires don't fall because they lose a war. They fall when they lose the ability to roll over their debts. That's what no one wants to say out loud. That the mighty aren't undone by enemies, but by interest payments. The Roman Empire paid its legions in silver. When silver ran short, they debased the coins and lost the army. The French monarchy issued paper backed by land, and when trust cracked, the revolution began. The British Empire financed its fleets with bonds until the pound collapsed under its own weight. Now it's our turn. The American system runs not on gold, not on oil, not even on military power, but on the bond market's willingness to believe. And belief is fragile. This is the truth beneath all the noise. We've built a world where everything, your job, your mortgage, your savings, depends on a system that cannot afford higher interest rates and cannot survive lower ones. A dead end paved with promises. And yet we keep borrowing because the numbers don't scream. They whisper slowly until it's too late. They whisper in 25 basis points, in silent bond auctions, in rising deficits and falling reserves. We are taught that money is neutral, that debt is just accounting, but it's not. Debt is power, and money is trust, and both have limits. When governments borrow too much, they borrow the future. When they lie about it, they collapse the present. The laws of arithmetic are not negotiable. You can rig markets, change definitions, suppress volatility, but you cannot cheat compounding interest. It eats empires, slowly, then all at once. So if you're watching this in 2025, know this. The bond market is not just a market. It is the hidden nervous system of our civilization, and it's misfiring. There's no hero coming, only choices, default or devalue, and every day of delay makes the cost higher. If that chills you, it should, but don't look away, because if we don't understand what collapsed in 1994, we won't survive what's already collapsing now. If this gave you a new lens on power, money, and collapse, share it. This time, people need to know before the shock.